Assalamualaikum and hi, my name is Nurun Ain. I will talk about introduction and risk profile assessments. Yusri and Lisa, a married couple in their early 30s living in suburban Malaysia, aim to retire by age 50, giving them 20 years to build their retirement fund. Currently, they have 100,000 in savings and combined monthly income of 50,000 ringgit, with Yusri earning 8,000 ringgit as a software developer and Lisa earning 7,000 ringgit as a freelance graphic designer. Monthly expenses of 5,000 ringgit and a monthly savings rate of 6,000 ringgit, all while striving for a comfortable financial stress-free retirement through strategic investment and risk management, tailored to their goals and income variability. Risk capacity is individual ability to take on financial risk based on their financial situation and obligation. Both have a stable, well-paying job providing a consistent monthly income. For saving, they have a solid emergency fund and additional savings, and hence their ability to take on risk. While investment horizon is long-term horizon supports a higher risk capacity, so the risk capacity is moderate to high. Given their stable income, substantial savings, and long investment horizon. Financial obligation refer to the debts and regular payment that an individual or household is required to meet. The financial obligation for this couple is children education, which is they need to save for their children's future education expenses. And then monthly expenses, which is regular payment, include house mortgage, healthcare costs, car loans, and living expenses. They also have a debt, but their debt is a manageable levels of debt from mortgage and loans.
Next, asset allocation strategy. First, equity allocation. 60% of the portfolio should be in equity for growth potential. The recommendation fund is Kenanga Growth Fund that focusing on medium to long-term capital appreciation. Second, fixed income allocation. 25% of the portfolio in fixed income asset for stability and consistent income. The recommendation fund is Kenanga Bond Fund that offering lower risk and regular income. Third, alternative investment. 50% of the portfolio in alternative investment, real estate of commodity for diversification. The recommendation fund is Kenanga Balance Fund, which provide a balanced risk return profile through a mix of equity and fixed income. Next, selection of unit trust fund. First, Kenanga Growth Fund for equity. It's recommended for the 60% equity portion of your portfolio, aiming for medium to long-term capital appreciation through diversified high growth potential stock managed by experienced professionals with a strong track record of performance. Secondly, Kenanga Bond Fund for fixed income. It is suitable for the 25% fixed income segment, focusing on steady income with lower risk compared to equities invested in Malaysia government security and corporate bond, managed by caution and risk-averse fund manager with a history of consistent return. Thirdly, Kenanga Balance Fund for alternative investment. This fund suggested for the remaining 50% allocated to alternative investment, offering a balanced risk return profile through a mix of equity and fixed income, providing diversification and capital appreciation while managing risk.
Hello everyone, my name is Nur Afrika Yasmin and I will be presenting a performance analysis of Kenanga Investors Berhad Unit Trust Fund from 2019 to 2023. The focus will be on evaluating historical returns, volatility, and risk-adjusted performance. Also discussing the risk assessment of unit trust funds from Kenanga Investors Berhad. Next, we have the Kenanga Balance Fund, which has an average annual return of 6.5%. Its benchmark is the Blended Asset Index, which returned 4.0% per annum. This fund includes a mix of equity and fixed income securities, leading to moderate returns with moderate volatility. It offers a balanced risk and returns profile with a Sharpe ratio of 1.1, reflecting modest risk-adjusted return. Lastly, the Kenanga Bond Fund. This fund has an average annual return of 4.2%, surpassing its benchmark, the Malaysian Government Securities Index, which returned 3.0% per annum. The Kenanga Bond Fund focuses on fixed income securities, including government and corporate bonds. It provides low return but also has low volatility, resulting in consistent performance with minimal risk. The Sharpe ratio for this fund is 0.9, indicating lower risk-adjusted returns, but it is considered safe and reliable. Now, I will be discussing the risk assessment of unit trust fund from Kenanga Investors Berhad, specifically focusing on helping Yusri and Lisa achieve their early retirement goals. There are three types of risk. First is market risk. Market risk refers to the possibility of investment loss due to overall market performance. This is particularly relevant for the Kenanga Growth Fund and Kenanga Balance Fund, both of which have significant exposure to the equity market. Equity markets can be volatile and affected by various economic, political, and social factors, leading to fluctuations in the value of investment. Second is inflation risk. Inflation risk is the danger that returns from investment will not keep pace with inflation, eroding purchasing power over time. This risk is particularly concerning for long-term goals like early retirement. Growth-oriented funds, such as Kenanga Growth Fund, can help mitigate this risk by offering higher potential returns that can outpace inflation. Third is fund-specific risk. Fund-specific risks include management risk, liquidity risk, and concentration risk. Management risks arise from the possibility that the fund manager's decisions may not achieve the desired result. Liquidity risk is the risk that an investment cannot be sold quickly enough in the market to avoid loss, which is typically lower for unit trust fund but can increase during market downturns. Concentration risk occurs when a fund has high exposure to a particular sector, region, or asset class, which can be mitigated by diversified funds like the Kenanga Balance Fund. Risk management strategy. To reduce this risk, Yusri and Lisa should consider a few key strategies. Diversification is essential. Spreading investment across different asset classes, sectors, and geographic regions to reduce exposure to any single investment risk. By allocating their 100,000 ringgit across the Kenanga Growth Fund, Kenanga Balance Fund, and Kenanga Bond Fund, they can achieve a diversified portfolio. Regularly reviewing and adjusting their portfolio ensures it remains aligned with their financial goals and market conditions. Including funds with higher growth potential like the Kenanga Growth Fund help protect against inflation. Relying on experienced fund managers can optimize return while minimizing risk. Allocating investment based on risk tolerance and time frame is also crucial, with a proposed allocation of 40% to the Kenanga Growth Fund, which is high growth potential, 40% to the Kenanga Balance Fund, moderate growth and stability, and 20% to the Kenanga Bond Fund, low risk and fixed income.
The main difference between the Kenanga Growth Fund and the Kenanga Growth Opportunity Fund the Kenanga Growth Fund is about actively invest in diversified portfolio of Malaysian equity. Second is aim to provide long-term capital growth, and the third performance is measured against the FTSE Bursa Malaysia KLCI benchmark. And the Kenanga Growth Opportunity Fund is about focus on investing in relatively smaller capitalized company with good growth prospect. And second, aim to achieve consistent capital appreciation over the long term. And the next invest primarily in company with market capitalization of less than 4 billion at the point of purchase. And the last is invest in company with higher earning growth than the market average. Here are some recommendations of tax efficiency investment strategy in Kenanga that Yusri and Lisa can follow. First, utilize tax-exempt investment. Invest in Kenanga Growth Fund as Malaysian source dividend from the fund are exempt from income tax. The second is claim dividend tax deduction. Invest in the Kenanga Growth Fund and claim the qualified interest income dividend, which are refunded to unit holder on a yearly basis. And number three, minimize capital gain tax. Hold the investment in the Kenanga Growth Fund for the long term to reduce the impact of capital gain tax, which are imposed at rate of 24% for individual and 20% for company on the profit made from selling unit. Adjust the cost basis of unit for any distribution received, as these are considered return of capital and reduce the investor cost basis. And the next is offset capital loss. Use capital loss from the Kenanga Growth Fund to offset capital gain, but note that any net capital loss cannot be used to offset the other type of income. And the last is consult with a tax professional. Works with tax professional to develop a comprehensive tax efficiency investment strategy that align your specific financial goal and risk tolerance.
Yusri and Lisa, a young couple from Malaysia looking forward to an early retirement plan, are seeking advice on investment of their 100,000 in unit trust. This paper should act as an investment report through which they should identify the most appropriate unit trust investment to make given their goals. In particular, it assesses the Kenanga Growth Fund as an investment opportunity, discussing its fees and expenses, and stressing the necessity for investor to conduct frequent checks and adjustment to achieve the best possible returns. Evaluation of fees and expenses is like any other unit trust. The Kenanga Growth Fund has been associated with certain fees and expenses that
affect the investment?
First of all, the management fees that can amount from 1% to 2% of AUMP for the services of professional portfolio manager. Secondly, there may be a sales charge when buying unit through a financial advisor. Thirdly, redemption fees may be charged if the units are sold after a stipulated time with the aim of encourage long-term investment. Altogether, these fees make up the cost structure of the fund and should be critically analysed because they can reduce return expenses that can affect the investment. This company, Kenanga, has established that special attention to monitoring and review of unit trust investment is very crucial, especially in light of achieving early retirement plan. With the help of fund performance analysis against specific benchmark, investors are able to identify discrepancies and ensure that their objectives are met by the fund. Metrics such as annual return, expenses ratio, portfolio composition, and risk-adjusted return are useful measures to facilitate the monitoring. The Kenanga Growth Fund may be one of the suitable funds that fit Yusri and Lisa's plan to retire early. However, special attention should be paid to discussion or fees and expenses to achieve the highest possible profits. Observers' commitment to a strict monitoring schedule, including quarterly and yearly reviews, as well as the constant monitoring of the key performance indicators, will help Yusri and Lisa to manage their investment portfolio efficiently and move gradually towards an early retirement. Thus, Yusri and Lisa can improve their chance of attaining early retirement, along with optimize the investment returns by making wiser decisions in unit trust investment, keeping constant vigilance over unit investment, and conducting a periodic evaluation of the investment plan.